Hey everyone, it's Steven, and I got a short, quick, and to-the-point video for you today. You know, a lot of us who've watched CNBC or Bloomberg or who have read blogs like The Motley Fool, you've definitely heard commentators, moderators say things like, this stock had a precipitous fall today, or this stock shot out of a cannon today. We had a major rally today. We had a major sell-off, but a lot of that's just hyperbole, okay? There is actually a way to determine if a stock moves too much on a given day that actually does have a crazy up move or a crazy down move. So I'm going to show you how to figure that out today in less than 3 minutes. So here's the deal. What is implied volatility? Well, implied volatility is the 1 year expected move in a stock. So the way we figure that out is we take the stock price and we multiply that by implied volatility, and that gives us the 1 year expected move up or down. So if you have a stock that's priced at $100 a share and we have a 20 implied volatility, we'll take the $100, multiply it by 0.20, and we get an expected move up or down of $20 in the stock over the course of the next year. So that would be up to $120 and down to $80. But we could take that equation, add a little bit to the end, and be able to determine the expected move for a stock for any time frame. So we take the stock price and we multiply it by implied volatility, and we multiply it by the square root of how many days we're interested in over 365. So if we have the $100 stock price and we have the 20 implied volatility and we're looking for 50 days in the future, well, with a 20 implied volatility, that's about a $7.40 move up or down, okay? Now, how can we extrapolate this down to on a given day, right? Because the whole point of this video is, did that stock really have a quote-unquote precipitous fall today, or did it shoot out of a cannon today? And the way we can figure that out very, very quick and dirty is by using some sort of a rubric like this, a legend like this. We can also use this to determine if a stock has gone too far on a single day. So here's the deal. A 19.1% implied volatility of a stock is a 1% move per day. Okay, a 1% move per day. So if we take a look at my expected move calculator, for example, if we have the price of the stock at $200 a share, and we have a 19.1 implied volatility, and we put in 1 day, as you can see, that is an expected move up or down of $2 on a given day, which is 1%. And then we can extrapolate that into multiples. So for example, if we take 19.1 and multiply it by 2, we would get 38.2. And all we're doing there is changing the implied volatility, and then the percentage changes. So it's a very, very quick and dirty, easy way to determine, did a stock have an outsized move or not? So let's go ahead and take a look at an example. I'm going to go ahead and take a look at the stock BOX, symbol BOX. In the Thinkorswim platform, and again, they're not paying me to say any of this. I don't get any benefit from showing this. But in the Thinkorswim platform, I go to the Analyze tab, add simulated trades, and I type in the symbol BOX. If I go down all the way to the bottom, I get today's option statistics, and I can see that we had an implied volatility of 43.37%, which means the 1 day expected move, we can kind of figure that out. If we had a $20.55 stock, 2055. We had a implied volatility of 43.37 on 1 day. That's an expected move of up or down 2.27%. So if we take a look at BOX, for example, while BOX did move up about 1.5%, that is well within the expectation. So a lot of people on CNBC, some of those moderators might have said, BOX had a big move, a nice rally today, but the reality is, according to how we actually figure out this information, well, that is par for the course, and that's well within its 1 day expectation. Now, the most important thing here is how can we actually take advantage of that? Well, what we can do here, as this loads up, is how can we make money from this? So here's the deal. By using the 1 day expected move in a stock, we can have more context into whether a stock is and whether a stock's move on a given day is too large, right? Which combined with other factors may be a sign that the stock is exhausted. And again, very easy, quick and dirty. If you see a 19.1% implied volatility, that is a 1% per day expected move. If you have a 38.2% implied volatility, that is a 1 day expected move of 2%. If we have a 57.3% implied volatility, we have a 3% per day expected move. And again, I have this nice and easy cheat sheet that you guys can use to determine this information, which I will go ahead and share with you in the description below. Nice job, everyone. I'll see you all on the next video.